So welcome to the fourth day. Now, I'm assuming with the interesting one, the previous one, you're probably anticipating what goes into the fourth day with the long-term portfolio, and this is what I feel has exponential effects, right? And if you go and follow the right steps here, it definitely can give you the outcome. Of course, the global scenario changes, a lot of other things changes, but if you put the right risk factors in play, this should be one of the criteria that you should be looking at from a long-term point of view. All right. So what happens in a long-term strategy, right? What we did for short-term strategy, some of the components, right, comes into play here also. But besides the technical analysis we did over there, we require to do the fundamental analysis of a particular company. Now, it is not as simple as doing fundamental technical might give you the right results. It doesn't work like this, right? There is constant monitoring, but if you do your basic homework right, your probability of getting the right outcome increases multifold. Okay, so typically a long-term strategy consists of pyramiding. You know what that is now. You understood price action, so you look at the graph from a technical standpoint and you draw your trend lines and see where things are going. You do your fundamental analysis. This is knowing the company better from its balance sheet and its other criteria of basic ratios or financial ratios that indicate that how is the health of the organization, what is the management of the organization, and so on and so forth. So that is fundamental analysis. Then you also do sector analysis. That means that company for the anticipated stock that you're going to buy, how is that sector per se doing, right? It can so happen that given the global scenario, things might not be looking good for the sector, so hence that company per se might not perform as well. So sector analysis helps you to give you that edge. Maybe if the sector is okay, the company is okay, and the indicators are showing right, there's a higher probability it will go in the right direction that you're looking at. Okay. Now besides that, there are key ratios I talked about. This is part of the fundamental analysis. This gives you all the elements which are also hidden within the organization in the balance sheet. Okay, and we'll see that in the subsequent ones. So after you do all this, there is a long-term portfolio management, right? You have to churn portfolio also at times when you see things are not going the way you think it should otherwise, right? Now to do that, the framework or the steps to do that is given on the top blue screen, if you will, right? The blue table. When you saw the short-term ones, right? You also look at the mid-term. That is, if you take a positional view on some stock and you see it going the right direction with your pyramids forming in place, and then you do all these elements that we talked about, that becomes a candidate for your long-term. Otherwise, right? That's an organic way of putting the mid-term, or rather the mid-term stocks that you have chosen right from your short-term ones can qualify into your long-term ones also, right? But that is not the only criteria. Inorganically, if you shortlist something from the criteria of your screeners and the other activities and doing some fundamental analysis, you might directly jump into the long-term portfolio without really going out from what happened from the short-term ones. Now, having said that, we follow the SAPRM methodology in this case, right? There are about 5 steps to this. First one, as we did in the short-term one, was sourcing. That means you screen a particular stock, then you analyze it by both fundamentally and technically looking at it. All right. There are various ratios which I will share with you, and it's downloadable. Some of them, like there's a special mention for Buffett strategy, right, which consists of a particular specific kind of ratio that he looks at, and there is a criteria to it. If you follow through, that helps you in enhancing your or shortlisting your long-term portfolio stock ingredient. And then there is the soft factor or the entry barrier factors, which is you should find companies which have a strong moat. And for the people who don't understand a moat, it is typically in earlier times, if you see the castle, right, there was a lake or a river flowing across where the castle, right, typically, which was very difficult for the enemies to cross over to come to the other side, and by the time they come, they are so weak that they can be pushed away. So that is the basics of a moat. Now the moat in this case in the business world is you create an entry barrier which is so strong that the other businesses cannot follow suit, right? We learned something about that in the previous ones, that you create entry barriers for others in a blitzscaling mode, so that by the time they reach, you are much ahead of them. So this is that, right? So you find businesses which have a very strong moat and find very difficult for people to jump into. From a third criteria, the price criteria, right? So then once we move from analysis and now it's past that, so to speak, element of activities from SAPRM perspective, the P is all about pricing, the entry and exit, for which the calculator that was shared, right, the position sizing, depending on what you create out of it, you put your entry and exit criteria. Now you can choose to be independent of the positional sizing activity, and you can choose from a long-term perspective based on the price action or other indicators that you see that can take you there, or you can be a simple observer of how the price action moves and take your choice accordingly. Okay, so long-term ones help you in doing that. Now with that said, the risk reward ratio, right? Then you also have to put something called an LOC, a line of control, or a stop loss, if you will, that below that criteria, when this stock comes in, you should get out from a risk reward perspective, right? Because it can go all the way down. You might not know why, right? So that's the uncertainty of the stock market or a particular stock that you might be looking at. So those stop losses are very important. You can put a trailing stop loss, right? That's how that works also. A trailing stop loss is that, if one criteria is met of a stop loss, you might take maybe 50% out. That's a reverse pyramiding, if you will, right? Then if it goes further down, right, because there's a chance you do that because you might think that it will come up again, then you remove another 30%, and it goes further down than 20% and you're out completely. Maybe other 30% reverses again, then you average yourself upwards, okay? So that's how this works. The trailing stop loss works sometimes there. Trailing stop loss is effective in the short term ones also, okay? So I didn't touch on it because it requires expert level of activities, but it works there also very well. But in a long-term perspective, it helps when you know that stock is so strong that it will reverse. It would have gone down for some news or some disaster happening somewhere, like a Ukraine war or a pandemic coming somewhere. But fundamentally, the business is strong. It might definitely reverse sometime or the other. So then you do these things. Okay, then the M is the management, right? How you manage the trade. The trade management is all about how your investment or your risk reward ratios, or what is your criteria of managing risk to the extent it does, right? One of the ways risk reward ratio management, but largely you observe and you create and you average out or you average up or you average down, or you pyramid to the point where you think it is right, or you reverse pyramid to the point where you think it is not right, and then go about. So that's a whole trade management activity, which has the last of the three, that is the four element, the SAPR comes into existence, right? So then you exit accordingly. Now what is mentioned over here is 5% of investment. So I typically, what I do from a larger stock management perspective is, if I have chosen in my larger scheme of things that I want to put a capital of say $1 million or say about 1 million rupees, and I will only choose 10 stocks or maybe 20 stocks. I'll say only 20 stocks. That's my criteria, by the way. I choose only 20 stocks, the top stocks that I will invest in. But the maximum investment out of that 100 million, about $1 million, or million rupees, I will use only 5%. Right? That means 50,000 rupees in only one stock, or 50,000, or if it's a 1 million USD, then 5% of that into that one stock, out of which I make then 20 stocks. So if they go up or below, I take my profit out and maybe churn it further. That's how I use it, right? And churn it further would mean I either buy another stock, right? Or if a stock is doing bad, I might come out of it and buy a new stock which is there, and which I might want to put as part of my portfolio, so that the 19th, the 20th doesn't come from there, right? If all of them are doing very well, I take my profit out and I put some in mutual fund, I sip in the other one, right? And so on and so forth until they keep on growing. So that money that comes out of this, I then churn further or use it for further investment in the other domains that I'm looking at, which I mentioned to you earlier, and I see how that could grow from that point of view. Okay, so this is long-term strategy that we look at. So SAPRM is the methodology of doing that. Now we'll go into understanding what fundamental analysis is, because technical analysis you got a view of, and we'll maybe do a practical one to understand how in the larger scheme of things that could work. Okay, I will see you in the next one where we talk about the specific into fundamental analysis of this. Okay, bye, see you there.